All right, welcome to today's recap. This is Christian from Tribeca Trade Group, and well, some pretty nasty end of day price action in the U.S. indices. Keep in mind last night when we came in this morning, we were down, and we basically finished, I think, very close to the lows of the overnight session. I'll check that in 2 seconds, but uh, you know really was not a great sign last night. When Japan opened, it opened up basically on the highs. Same thing when the Hang Seng opened up last night, opened up on the highs, and they both closed on the lows. So, we kind of came into today and futures were down. And then you looked over at Europe, and Europe was up, and Europe continued to rally throughout its session after being down. I think the DAX was down 6 or 7 days in a row. So, a little bit of a bounce there in Europe helped us out, I believe. But too many things, too many movers going on, and I think that has some of what's going on right now, which we'll explain. But you could see the S&P basically finished where we were at like 3 o'clock in the morning last night. So into value, futures really sold off here at the end of the day. You go back to the daily chart. What can we learn from this, or what can we see here in S&P futures? Well, it's you know yesterday obviously was a nice rally back day, from the lows, but sometimes this it takes a little while to really regain some levels. You have what's called, this term that they like to use is there's a lot of dead bodies that are left up here, and there's a lot of supply. The 50-day moving average was something that we had tried to get to retake, and we could not do it. So I was just turning down my TV. Unfortunately, we got stuffed right here at the 50-day moving average. So same thing if you look at Nasdaq, which Nasdaq was actually, yesterday was doing extremely well, was leading, and today nobody wanted tech shares today. So where did this thing fail today? At the bottom of value. So value areas, moving averages, these are why I use them. They come into play a lot in terms of really good support and resistance levels. So, first things first, we're going to have to retake that 50-day moving average, and closing on the lows. It's not too good. It's not too good. So it does take time. I'm going to talk a little bit about the VIX, because right now, like, that is, a big thing to watch all day long, until that straightens itself out. So let me talk about that, and then I'll talk about interest rates, which is also, there seems to be bleeding in multiple areas, or multiple things to keep your eye on that are amiss right now. A month ago, everything was fine. There wasn't really much worry. Now there's like 2 or 3 things that seem to be problematic. Hopefully temporary. Hopefully they're all temporary type things, but we don't know that, especially with interest rates. So let me just talk about the VIX for a minute. I saw a couple questions. I actually tried to respond to somebody's tweet on Twitter today. People are saying, "Hey, why is this VXX thing up and the VIX is down today?" So the VIX did end up down 27%, and then people don't understand the mechanics, or even look at the website, and they're like, "Oh, it's broken." Well, no, they're not broken. They're doing what they're mechanically supposed to do. There are some certain things, like, so you could see, for example, what is the VXX holding, right? It's holding February, and it's holding March contracts. You could see it's now more March than February. But so does it make sense that the VIX was down this much? And you could see it actually rallied towards the end of the day, which again goes right into the to what we were talking about with the major indices, moving up, and sorry, with the major moving averages. With the major indices moving down at the end of the day. Can you tell it's been a long day? So the VIX really ramped up there at the end of the day. So still finished down on the day, but again, not out of the woods. The overall level is a 27 in the VIX. That is much higher than where we were a week ago. So great to see yesterday that this thing did not get over 50, but it's going to take a little while for this thing to cool off. So one of the things that you have to realize with the VXX, which, again, before I change the screen, the VIX is down 7%, and the VXX is actually up, right? So why is that? Well, because if you look at what it's holding, and again, I'm not an expert. I'm not an expert on the VIX. I know enough to get by. I've read the prospectus and I look at the website to see what kind of contracts they're holding. But this is the February contract. Notice what the price is of this. It's $23. Then take a look at the next. So what the VXX is holding, and you could see that the March contract. One is 23. The nearer dated contract, February, is 23. And the further out contract is 19. That's not how futures are supposed to work in a normal market. Usually it's in a contango market. The further out month costs more than the front month, right? Just think of it in terms of options, right? When you go to buy a February option, let's say an at the money option, it doesn't matter. Say it's SPY, and it costs $1. Logically, you would think March it would cost more because you have more time, and there's some other things going on there, but you have more time, so the March contract should cost more. This is showing that the February contract is 23 and the March contract is 19. So this is called backwardation. This is usually a short-term problem area for the time being. So it needs to flip around into a normal contango market where the further out month is more expensive than the near month. So that's something to keep an eye on. Until this flips around, that there's something up in the marketplace. There's a heightened sense of fear or volatility. All right, so that's something to keep an eye on. Again, I'm not a VIX expert, but I know enough to really get by. I used to trade these products and used to know how to hedge them when I was, when I used to block trade for ETFs. All right, so that's the story with that. Next, so I think you have to keep an eye on this until this flips around, because it's just showing that there's a lot going on right now in the near term that people are a little bit frightened of. So really, bonds. Somebody had a great question, and there's been some great questions in our trading room. They said, "Can you please explain the relationship between interest rates and SPY or SPX?" Well, I don't have like a chart that shows like this. When this happens, this happens. You have to think about these things intuitively. So what's going on? And I'll walk through the process of what I think about. Right, so TLT is falling apart, and it's been falling apart since it broke the 100-day moving average. If you look at the bond yields right now, and I'll move to that screen. Wait for Bloomberg. Let's go over here to the U.S. so that we could see a couple different rates. You can see the 10-year is really spiked up. It's at 2.83 right now. So can the market handle this type of, I think I got the right screen up. Can the market handle this type of a rate? Yes, I think anyway, but it's really the speed of these moves where the market gets very jittery. Same thing with anything outside of the equity market. When the dollar moves really fast, it shocks people and it gets people really, it unsettles people. And anytime there's that, people get a little bit frightened and they tend to pull back and maybe take some risk off, right? So this has been a pretty quick move. We moved from 240 to 283. There was a tweet out by Stephanie Link, which I retweeted, saying that the 5-year adjustable mortgage right now is the highest it's been since 2011, right? So things are starting to, they're going to start affecting regular people. The other thing is, right, borrowing costs. So when borrowing costs go up, regardless of, what financial media likes to talk about is the tax plan. So regardless of the tax plan, if it's going to be a lot more expensive, expenditures are going to be a lot more expensive, it affects things. It affects things a lot. Also, not even talking about what happens too with the flow of funds too. There's been a lot of pent up demand in things like utilities, and things like REITs, dividend stocks, right? So when yields start moving up that much, there's less of a demand, and you can see what's happened to utilities. I mean, utilities have gotten absolutely smoked. They were up here, they were making new highs back on in November. They went from 56 down to $48. So that tells you what people are really taking money out of there quickly. Same thing if you look at stocks like J&J. J&J is a kind of a safety area. This name, of course, did have had earnings as well, so it's not the only thing, interest rates. But J&J is one of those names that people buy for the high dividend yields, right? People like the dividend yields, and if Treasury rates are going higher, there's less of a need to be in stocks for their dividend yields when you could just go into Treasuries. So usually this flips back and forth, but I would watch right now, considering we basically just, are right at the week's lows. The next level down is this 116, which will probably, you could look at IEF, which is the 7 to 10 year, which is also, you could see, is right around this week's lows. So TLT finished down about 1%. That's some cause for concern of what's going on in this market. All right, so that's some things to watch. And we talked about this last week too when this happened. But you got to, for me, I'm a macro trader, so I keep an eye on everything, because I think everything, your Facebook and your Google and your Apple don't operate in a vacuum. They operate in the global context. So just like in regards to option flow, which I look at tremendously, but that's not the only thing to look at, especially when there's high volatility or higher than normal volatility markets. It doesn't really matter if someone buys a bunch of calls in something. It's really becomes secondary. When it's a low volatility environment, then it's a little bit easier to trade some of these things. But you take, for example, EM. This is a name, I was out on Twitter yesterday saying, hey, this is, I got out of EM in my cash portfolio. Luckily, this is one of the few things that I, got out of this day. So at this point, I have no position on an EM, and I'm looking to get back involved. All right, and so I saw this yesterday and said, hey, we got to close inside of value. We got to close above the 50-day moving average. This is great. However, look at what this thing did today. It finished down, 3.2%, the EM ETF. So that's not confirmation to me that I want to be in this right now. And my whole thought was, hey, I could go back into this EM, and I've got a simple trade here. I could go long versus the 50-day moving average. And I saw this trade go up earlier. It looked like a nice, big, chunky June 49 calls that went up in EM, which is great. It looks like a big trade. There's also some buy rights. You could see a lot of activity. But really, do I care if so-and-so fund puts on, a huge trade? Because they could lose money on it, right? We know hedge funds not blow up, but hedge funds do poorly. So I may be able to get into this trade cheaper once the volatility subsides and I get a little bit of confirmation, right? I need to make it fit into my trading model. That's the most important thing. And, so I would rather wait for a little bit of confirmation. Maybe this closes back above 48, and then I've got my stop price at the 50-day moving average. Other than that, I don't want to mess with it. I've written it down. I will come back to it. But same thing with a lot of other option trades today. They look like great trades. Today I've got, a handful of names that I thought were really interesting today. There was a big Gilead call buyer. There was repeat Microsoft today. There was some nice DHI calls that went up today. A beaten up home builder that has acted very well previously on option activity. But again, all this is secondary. The market, the volatility needs to come in and relax a little bit. So regardless of people on Twitter talking about, how great the option flow is, and then when the market goes down, then they say, oh, the option flow isn't that, it's quiet. There's so many people that are just they're all after the fact, and they don't have any skin in the game. So they sound great. They all sound great after the fact, after the day's over. But I'm trading real money and I will wait until it fits my trading system, and then go about my day. If it doesn't work out, I have to get out of the trades. So for now, no trade in EM. Same thing I was looking at MCHI. And same thing with this one. I think it needs to get back above that 50-day moving average and back above, 69.83, around $70. So I think at this point you have to take one day at a time. What I'm doing is concentrating on, what I see on the tape, what kind of market environment it is, making sure that I go, if I am trading options, I'm making sure I give it plenty of time. I've been getting the question about, hey, what do you think about weekly options here? Really, really risky. If you're comfortable with losing the whole amount of premium that you're buying, then fine. Then your comfort level is fine. But I think right now, as fast as things are moving, if you're not comfortable with losing 100% of the option premium on a weekly or front month option trade, then you really should not be trading those types of options. Because they are right now are extremely risky, and the market is moving much faster than it was a couple of weeks ago. Again, I can't give recommendations or advice to anybody. This is just for information only. But I'm telling you what I would do, and I would not be comfortable trading short-term options unless you are comfortable with losing the whole 100% of the premium, because that's how fast things are moving. They could work out for you too. You can make a double or a triple really quick, but the risk is much more than it was 2 weeks ago because of that volatility component. All right, so tonight, I think you have to. I will be watching overnight markets to see what Asia does again, and then we'll see what Europe does as well. This is a lot more than just what the U.S. is doing. All right, guys, have a great night, and see you tomorrow.